My name's Bob Cunningham. Krista, who's had to run down, and she's here. I work in the Pro Support division. I've worked for TaxSlayer now for about 5 years. Prior to working at TaxSlayer, I had a long career in both law and in accounting. I've got backgrounds in both those fields. And I was fortunate enough about 7 or 8 years ago to retire, to take care of some elderly parents, and to spend more time with my children. Unfortunately, my parents passed away, my children became teenagers, and I decided that I wanted to do something else, go back to work, so I went back to work for TaxSlayer. I talked to Chad about this little part-time job that I would have at TaxSlayer, and it turned into, during tax season, 65, 70 hours a week, and the rest of the year, somewhere around 45 to 50 hours a week. So my little part-time job has turned into this. So what we're going to be talking about here today are K1s. And, you know, there is one of the animals right there. This is something that I'm sure you've all seen. You all deal with in your practice. And so we're going to do this. And this is what we're going to try to cover here today. This is going to be our agenda. We're going to have some basic concepts. One of the reasons we're going to do basic things is because we understand that the range of knowledge that people have when they come here. Some people are maybe more new to the industry. Some people, you know, and some people are very sophisticated. So we're going to try to get get something for everybody in here. We're going to talk a lot about the entities that create K1s. The 3 different entities that can, or the 3 different types of K1s that we can get. Talk about entering them onto the tax return. We're going to talk about common issues, things that we see a lot of, trying to make it more practical for you. And I really went and I found what in support would be like the 10 most common things. By looking at call notes and stuff, the things that people regularly call in on. And then last, and we won't spend a lot of time on this, we're going to go through what resources we have available. Things that you may not be aware that we have that can help you particularly with that difficult K1 that you may receive that has some peculiar item you've never seen before. Where does it go? How do we deal with it? Where does it flow? That type of thing. We have some resources that people, again, may not be aware of. All right, so why are we doing this? For the first time first time since I've been at TaxSlayer, when they were putting together the agenda for this, they brought in 3 of us from Pro Support, people that actually talk to y'all, and they said, what are people calling? What's their questions? What are they calling? And so we came up with, well, we gave them a couple of topics, and one of them we said was, we get a ton of calls on K1s, people having problem with this. So this is why. First off, K1s are very common. Some people do not realize it is a very common source document. In fact, it is the 4th most common document you will touch as a tax preparer. It used to be the 3rd most common document that you touch, but it recently, in the last year, and it was only in the last year, that 1095Cs started to widely get issued by employers on the healthcare law. Prior to that time, prior to last year, 1095s were not issued as commonly. A lot of employers got they just didn't do it. 1095Bs and Cs weren't filed. But to this day, right now, K1s are the 4th most common and historically have always been the 3rd most common source document after W-2s and 1099s. And we know there's lots of different 1099s, so there's a lot of them. Second reason, it's one of our most common areas, and I've already mentioned that, but it's one of our most common areas. We did this 2 years ago. Kirsten and I, we went through all the call notes and we did data mining on the call notes. And we get, during tax season, approximately 60,000 incoming phone calls. About a quarter of those phone calls get classified as tax questions, but that can be a lot of different things. And so we didn't just settle with all of that. What we did was we searched the words in all of those 60,000 phone calls for certain keywords. And the number one word that came up, number one phrase that came up was network in all of the notes. People having something about networks, server, something like that. The second thing that came up was healthcare, or something dealing with the healthcare, Affordable Care Act stuff. And believe it or not, the third most common thing that we saw in the notes were K1s. In fact, we get about, in a given year, somewhere between 2,500 and 3,000 phone calls with people just calling us with questions on K1s. And that's just from the beginning of tax season till the middle of April. It's a lot of calls. I mean, every day people are calling us about K1s. Another reason why we decided to do this is because the IRS, as you all know, are doing more and more data matching. There's more data points. Now the IRS has created several data points from K1s. They match that. They're matching it when it comes into when they receive that return, they're matching that K1 data point to the recipient's tax return. You may get letters in the summer, you may get letters a year or two later, and the clients may be getting them because they have K1s that they didn't report, or there's matching items, there's a number on one of those K1s that's not flowing over. Next thing is, it impacts a lot of parts of the tax return. In fact, I believe there is no other document you will touch that can impact the tax return as much as a K1. This is all of the places, every one of those every one of those lines is a place where you have to enter stuff from a K1 onto the tax return. And as you can see, that's basically the tax return. I didn't mark totals, I didn't mark anything like that, but basically every part of the tax return can be affected by what comes in from a K1. So there's a lot there. And then last thing, we get these questions, they range from the very basic, like I mentioned earlier, to the very complex. It's when someone calls you up I'm on the other line, and someone calls up and they say, I've just entered this tax return and I've got some passive losses that have been that are being allowed, and I don't understand why. And I'll say, can I see that corrupt return? They send me the corrupt return, and they have entered 14 K1s on that tax return. And they have some of them are passive activities, some of them are non-passive activities, and finding the needle in the haystack as to why one item one was allowed and not allowed can be very difficult. It's very complex. And these are really the most common places where you're going to see it, and you're going to see it on these forms. And I don't know what y'all think, but to me, when I start working on an 8582 issue, on a passive loss limitation issues, that's tricky. Those can be difficult forms for us to work with as preparers. So this is kind of why we did this. And I forgot to say this at the beginning, but if you all have any questions while we're going through any of this, please just go ahead and ask them as we go along. I'll do my best to answer anything I can. If I can't answer it, I will try to get back to you with an answer. If it's too much in the weeds where we're really trying to get down into something that's not going to be, we may want to take it afterwards. I will be available afterwards, after each one of these sessions, and I'll be here all day. So that's kind of what happened here. All right, now let's talk about some basic concepts. Well, the first thing is K1s are created as part of another entity's tax return. And they are if you e-file that tax return, they are going to also be e-filed with the entity's tax return. And as I said before, they match it. They're going to start, we were looking at the business rules that are coming up, and historically they haven't matched things like the Social Security number on the K-1 or the taxpayer identification number on the K-1 when you e-file it. And they're not doing it again this year, to my knowledge. It's not in their business rules, but we've been told that that is something that they will be matching down the road. So this is going to make it even more difficult when you go to file business returns, because if you have a misname, you know how many times do you have problems just filing 1040s? You have name control issues. Now you know, down the road we may even have name control issues on what is on a on an 1120S return, if you have the names and the socials on those individuals that are going to K1s. But anyways, the IRS is going to be matching, they match all these data points. I'm sorry? Can you all hear me? I'll try to speak up.
Okay.
Yes, sir. All right. Okay, so another basic concept with this is any item that is on a K-1 will not be taxed on the tax return of the entity that sent it in. And again, for some of you, I understand this is pretty basic stuff, but this is just the way K-1s they will work. And any benefit, loss, anything like that that is on the K-1 has to be reported and taken by the recipient of that K-1. So what's on it, what you get on a K-1 comes in. All right, and the entity should provide a copy of the K-1. They have to provide a copy of the K-1 to the recipient by the due date of the tax return. A lot of preparers don't do it by the due date of the tax return. They'll do the tax return by the due date, but they don't deliver the K-1 to the recipient by the due date. And that's a technical violation. Usually it's not a big deal, but it can be a big deal when you see people that, you know, are late. And this is why it can be a big deal. There is a late penalty associated with this. And that late penalty is $195 per month, up to 12 months, times the number of recipients of the K-1. So if you have a return that's got 5 people on, 5 partners on it, or 5 S-corp owners, 5 beneficiaries, and you're 6 months late with that return, it starts to run into some real money, you know, because you're looking at almost $200 a month for each person. So getting those things out to people are pretty good. So that's just kind of some basic stuff. All right, let's talk a little bit about the actual entities that create these K-1s and what goes into what is on a K-1, because that's real important. K-1s are, if you take away anything out of this, take this away. The K-1 that you get is different, and it's treated differently based on the entity it comes from. Think of this, you get 1099s all the time. A 1099-R is totally different than a 1099 miscellaneous, a 1099 INT, a 1099 OID. They're all different. But a lot of people will call us up and they'll say, I have a K-1. What's it from? What kind of K-1? Because they're really different. And it's because the entities themselves and the relationship the entity has with the taxpayer, with the recipient, is totally different. These are the 3 different types of K-1s that actually exist. They come from a 1041, then that's going to be a trust and estate. They come from partnerships, and they come from S corporations. And when you think of this, I'm trying to make a representation, this is kind of the way they are. There is a part of them that has some commonality in the center. There are some things that are the same on each K-1, but for the most part, it's different. It's just, again, think of your 1099s. There is a small part of it that's the same on every one. It tells you who it's from, it tells you who it's going to. A 1099 always reflects an income item. It can have other items on it, but it's always going to reflect an income item. So that's the commonality between 1099s, the different types. But that's really the only thing that's common. A 1099-R has nothing else in common with a 1099 INT, other than its name, you know, it's from the same series. So, and the first of these entities can only pass through just a limited amount. The other two pass through everything that's on those tax returns, but the first one only can pass a limited amount, and that's an estate and trust, a 1041. There are a fair number of these, but not all 1041s issue K1s. They only issue K1s if they are distributing something to a taxpayer. So if you get a you get a K1 from a 1041, it's going to be coming from a trust or an estate. You should receive it by April 15th, unless it's a fiscal year entity. And the actual 1041 itself is being subject to tax. Do any of you do 1041s, or you do many of them? Okay. A 1041, the basic concept of a 1041 is a tax return. It only has an exemption on it of $300 for a trust or $600 for an estate. As such, that's the only thing that is not taxed, the only income that is not taxed on an estate or trust. $300 or $600. Everything else is taxed. The tax rates are the same tax rates that we have for individuals, except the brackets are very narrow. So if you have somebody who has approximately $30,000 in income in an estate or trust, they'll be paying tax at 39%, basically, 38.9. You know. So it's very progressive, the tax rates on estates and trusts. So it behooves people that do 1041s to put as much on that on a K1, because it's not taxed at the entity's level, it goes over to the recipient's level. So there's tremendous desire by preparers that do 1041s to get everything on, get all their income on a K1. Unfortunately, they're very limited as to what they can. And the reason is that in an estate and trust, the only thing the recipient has is what's known as a beneficial interest. And that beneficial interest is limited. And it's limited, and what it means is that you don't own anything. If you're the beneficiary of this, you own nothing. And you have no claim to anything. All you have is a beneficial interest, and you only receive things that the trust or the estate can pass down to you. If any of you have had to deal with like an estate, you have to pay all of the debts of the estate. You have to pay certain things, and you can't distribute anything to beneficiaries until everything else is taken care of. And so it's limited as to what they can send. And it's not an ownership interest. In an estate or trust, they're limited to what's known as the income distribution deduction. And this is getting a little bit into the weeds, but the income distribution deduction it limits items that can be given to recipients from estates or trusts. And it limits it to it can only be income. It's called an income distribution deduction. That means you can't distribute losses. You can't, like if they have capital losses, you can't distribute that to the beneficiary. You can only distribute income. The other thing, it's limited to, it has to actually be distributed. It's limited by the terms of the trust, will, or the state law, the statute of descent or distribution. It's limited to that actually has to be. So we'll get phone calls where people say, I want to distribute this on a K1 from an estate. And I'll ask them, I said, well, what did the beneficiary actually get? They said, well, we haven't distributed anything yet. You've answered your own question. You can't distribute something you can't have it taxed at that level in a trust or an estate if you didn't distribute it. Think about it on the other side. How would you like to get, if you be a trust baby, get a K-1 that says you have all this income and they never gave you anything to pay it? So that's why it works like that. But it all changes in the final year. When they do a final year, they then can distribute certain items that they previously couldn't do. So that's kind of it in a nutshell on estates and trusts. Let's talk more, because you won't see as many of those as you will see this, and maybe you do more of these yourself. These are the pass-throughs themselves. These are entities that pass through they pass through all of their items to the individual, or sometimes they pass it through to another entity because it could be a partnership that's owned by a corporation or something like that. So anyways, they pass through, and they're commonly known as pass-through or flow-through entities. You may use that term, you may have heard that term. There are a lot of these so far this year, and that's just through October. Those are the most recent numbers that I could find. That's how many partnership returns have been filed. That's how many S-Corp returns have been filed. There are more of these being filed all the time. I know everybody's kind of aware. We've been doing, they're talking about doing some tax reform. Who knows what that sausage is going to look like when they finally make it, if they make it. But one of the big items they're talking about is pass-through entities. Changing the tax rate on pass-through entities. There's been some thought that if they do that, that could greatly increase the number of pass-through entities, and it will be these two entities that people will be using, be S-Corps and partnerships. All right, what is an S-Corp? First off, it's a tax return that's filed by an S-Corporation. It is due the third day of the month. I'm sorry, it's during the 15th day of the month after the third month. So it's basically due on March 15th. It's due, if it's a fiscal year, of course, we follow those rules. It is a corporation that has elected to be treated as a pass-through entity. Every corporation that is formed is, I like to say, they're born as a C-Corp, and they choose.
I thought they changed the last day to the file.
I think you're thinking of partnerships. Partnerships were changed. S-Corps did not change. S-Corps remained March 15th. Partnerships used to be April 15th, and then last year they were changed to March 15th. And they actually changed C-Corps to the other way. C-Corps, they flipped them. They flipped them. And the logic for that, that's actually a good point. The logic why they did that was K-1s. If March 15th is the date the K-1s have to be delivered to the recipient, they still have a month to do their tax return before it's late. So that's why that was the logic, and it actually does make sense. It's good logic why they did it, because now it matches up a month before when individual tax returns are due. So the actual relationship that a K-1 recipient has with an S-Corp is that as an investor. And a lot of folks don't recognize that when they're entering these tax returns. We will get phone calls from people, and they'll be saying, they have an S-Corp, and they say, and I want to do certain things with that I want it to be dealt with certain ways. And I have to remind them, your relationship with that entity is no different than if you own stock in General Electric. You're a stockholder in that. You might be the controlling stockholder. You may have power over making decisions that S-Corp will make, but that's all you are. You're just an investor. And you have to think, when you're addressing certain things, you have to remember the fact that you're really just an investor in the thing. It's an ownership interest. And that comes into play with other aspects of things that you have to do with the entity. All right, on an S-Corp, all of your income, losses, everything are passed over to the individual, and I'm going to use individual, it can be another entity, but to the individual's tax return. And any NOLs, they don't remain with the corporation. The NOL passes over to the individual. So if there's a large loss in the entity, it flows over to the individual's tax return, and they get to take it on their tax return subject to certain rules. Income. The income people get from an S-Corp is not self-employment income. This means it's not subject to self-employment tax. It's not earned income. You can't have someone, we'll get phone calls where people will have an S-Corp, they make $20,000, they have $20,000 in income, and they call and they'll say, why am I not getting earned income credit? I can't, well, it's not earned income, you don't have earned income. It's an investment. You have an investment, you are an owner, you're a stock owner. It's an owner that you got, so it's not. And it can be considered passive income. And if it's passive income, it's subject to investment income. It's treated as investment income. It's subject to those types of taxes. And it's going to be treated differently. The way an S-Corp gets money, takes money out of it, is it can be paid by the thing. It can receive wages. Where I used to work, for many, many years, we were a large S-Corp. We had, our annual sales were around, I don't know, 700 million. Made large profits. We had owners. We had several owners. All of them worked for the entity. They all were paid wages. They were paid what is known as reasonable compensation. And that's what all S-Corp owners are supposed to be paid according to the IRS. If you work there, you should be paid reasonable compensation. That's not very common that we see on S-Corp returns that people pay themselves wages, but they should be paying themselves wages technically. And they also, the other way an S-Corp can get things is they can take distributions. They can just literally take money out of the S-Corp. You can draw money out. You can treat it like it's your personal bank account. You can just take the money out. And it's not that money that you take out, because sometimes people will call us and they'll say, this man just took a $20,000 distribution from his S-Corp. He says, what should he do with it? And I say, spend it. Because it's not income. It doesn't have any, it's not income, didn't have anything to do with income. Income is reflected on what the books and records of the S-Corp will tell it was. The S-Corp could have made $50,000 and he only took 20 cash out. The S-Corp could have made $5,000 and he took 20 in cash out. They can do that. It doesn't have anything to do with their income of the entity. Partnerships are a little different animal. People sometimes think they're the same. They're treated the same, but they are different. Again, tax return, it's filed by a partnership. This is the one that changed. It is now due on the 15th of the third month, just like an S-Corp. Previously, this was the one that was due on April 15th. It was due on the 4th. All right. A partnership has to have 2 or more people, 2 or more partners or entities involved in it. You can't have a one-person partnership. That's like having a one-person marriage. I understand that's kind of the thing some young people, I'm going to marry myself. Well, you can't be a partner with yourself. You can have an imaginary friend, but it doesn't work. You have to have 2 or more parties. And they have to do this. They get together to form a business. This is a little different than a joint venture that you would do on a Schedule C or something like that, or a husband and wife doing something on a Schedule C. That's totally appropriate. That's a different kind of a thing. Yes, ma'am.
What's considered a joint venture if it's not a partnership? How is it a joint venture?
You can have a joint venture. Sometimes it's like you and your spouse, or you do something, and they classify that. They can be classified. Yeah, it's pretty much going to be if you're going to do it on a Schedule C. If you're going to do it on a Schedule C, if you're not doing it on a Schedule C, it's going to be on here.
So anything other than spouses on a Schedule C is a partnership?
Well, it's not going to be on a Schedule C. It's going to be on a partnership.
Spouses are the only thing that can go
right.
on Schedule C.
Yeah. Yeah, the only business you can enter on a Schedule C with another person is one with your spouse.
Okay, other than that.
Other than that, it's going to have to be considered, it's a partnership. If you do it with your brother, your sister, your best friend, your worst enemy, who probably used to be your best friend if you went into a partnership with them, this is what you would end up with. You have to do a 1065 return. But you don't have to have a formal partnership agreement. That's not important. It's very helpful if you want to your best friend remain your best friend that you're in business with, but it's not necessary to file a partnership return. There are many different types of partnerships. There's many different types of partners. And these relationships, what they are, impact the K-1. If you're a general partner, it means something. If you're a limited partner, it means something else. And it can affect what income, what you can do on what you have to declare on your tax return, how it affects your tax return. All right, unlike an S-Corp, the income coming on a K-1 from a partnership usually is going to be self-employment income. It's not always going to be self-employment income. I just said you can be a limited partner and you could be passively involved in it. Years ago, I got divorced. Smartest decision of my life. Second smartest decision of my life. And after that, I had a couple of years where I was enjoying my life. And one of the things I did was I bought an interest in a horse, a race horse. It was a lot of fun. Not very smart, but a lot of fun. But I was a limited partner. And unfortunately, my horse didn't win a lot of money, ended up losing some money, and that was a passive loss for me, and I ended up not doing very well with it. The smartest decision ever I made was that I got remarried, and there's a happy ending to all of that. So anyways, this is income that you get from K-1s on that is going to be subject to self-employment. It's also usually going to make you eligible for EIC. It's earned income. We have a lot of folks that when they're setting up their structures, they will set up a structure of an entity, and they'll set up a corporation, and they'll make it an S-Corp. And then they get this income coming over from the S-Corp, and they're doing it because they think they can avoid self-employment tax. And then they get the income, it comes over, but it doesn't make them eligible for EIC. And my question to them is, why did you set it up as an S-Corp? Why didn't you set yourself up as a limited liability partnership? You would have had the same protection from liability. You would have had to pay self-employment tax, but your earnings would have been eligible for EIC. And if you're somebody who makes $25,000, $30,000 in an entity, it can make a lot of sense. Now, if you have somebody that makes a lot more than that, it might not. So anyways, so the relationship that you have in a partnership it's much more analogous to the type of relationship that a taxpayer has on its Schedule C than the relationship that an S-Corp owner has. But it can be similar to the S-Corp relationship if you're a limited partner and you have limited liability. All right. What happens? When you dispose of these things, the sale of a partnership can be a capital sale. If you sell the partnership, it can go on Schedule D, or it can be a liquidation and it goes on 4797. This question comes up all the time. S-Corps, you get rid of the S-Corp. What happens when you sell a stock? It goes on Schedule D. It's a sale of stock. That's what happened when you got rid of your S-Corp. You sold your stock. What happens if it just goes out of business? Became worthless. How do you treat worthless stock? That's what people need to understand. It's just An S Corp it's just a sale, it's getting rid of a capital asset. You're getting rid of your asset. You're getting rid of the stock. All right, now we're getting into the real structures of K1s. All right, all K1s have these three sections. This is the one area that they're all common. They all have information about the entity, information about the taxpayer's interest in the entity, and then it has the income distribution items. This is part one on a 1041. You can see here, it's going to have all of these items. They're going to be put up in here. It's going to tell us the information about the entity. It's going to tell us what went in there, the name, the address, the EIN. In this case, it will tell you if it's final. That can be relevant because, as I mentioned earlier, certain deductions can only be taken in the final year. And then the last one, it's got it tells you if a 1041T has been filed. And that's if you have an estate or trust and they are distributing money to you, they should have a 1041T that's been filed where they've withheld some taxes. They've paid some taxes. They've paid some estimated taxes, and that's telling you that there are some taxes that are out there that are going to be filed on your behalf. This is the way it looks on an S over here, and this one's going to be on an S Corp. And you can see it's very similar in that first section. It's just got name, address, EIN. It's just basically all of that information there, and we'll do the partnership one too. All of that's going to say up here this basic information about the partnership. It's also going to tell us in a partnership if it's publicly traded. Some partnerships are actually traded on exchanges. Large partnerships, usually they're oil and gas investments. They have special rules. We'll talk a little bit about them when I talk about the problem questions or big problems areas that we get. We'll mention those. But that's what these are. All of those items, this is the data point. This all will go in. The IRS, this is how they send you the letters. They're looking, this is data point. They are matching that information in part one or part two. I'm sorry, part three of, got the wrong thing. Here on Schedule E, it's on line 28 and 33. You have to, you put in your, it's got that information, and the IRS matches, this is data point that gets matched. So if you get a letter, it's because you didn't have a Schedule E on that 1040 that has that information on it. It's not matching the Social Security numbers of the tax return. It's matching the EINs of the entity. So if you miskey the entity, and sometimes people miskey the EIN, that's where you'll get a letter. That can generate letters down the road. All right, part two of this is information about the taxpayer, the recipient of the K1. All part twos, come to the taxpayer, identify who it is. But this is where you really start to see a difference between the K1s. In this case, this is just one coming from a 1041. It just basically has information, who the beneficiary is, name, address, Social Security number, or tax identification number. The K1 that comes from an S Corp, same thing. The only thing that's different is it tells you how much he or she owns. It gives you a percentage. You put, so that way the IRS knows that he's 50% owner, 20% owner. So that number there is going to match. If there's income on that, coming in on that S Corp, it better match those percentages. And then lastly, we see this one. This is the one that's very different. Look at all of this information that's on the partnerships. Tons of information in this section. It's got all of these items that you have to, that are coming in. Why is it different? Well, we're going to talk about that. Basis. This is a real important concept. A lot of folks, you can't, when you have pass-through entities, there's a requirement, the IRS requires, let me go back, the IRS requires that everybody who owns a partnership interest or an S Corp interest maintains records of basis. Why is that? It's no different than any other capital asset transaction that you deal with. If you find anything that you do on Schedule D, what do? They ask you, what's the basis? What's the cost? What's your cost? You have to keep records of the basis in these entities. There's two types of basis. First is the investment basis, which is what's the investment in the entity, and then the second part is what's the debt basis. What is the entity? What do you owe? The IRS recently did a seminar. They did a webinar. They did a well, it was two-part webinar, and all was just on debt basis, on stock basis. I don't know if any of you watched it. No, it was pretty good, but it was just simply on basis, on the debt, on debt basis for S corps. All right, why is it so important? Well, you can't take losses from these entities on your personal tax return if you don't have basis in the entity. If there is no basis, you can't. If you don't have anything at risk, you can't take the loss. It goes to basis being a factor in the at-risk limitations. And finally, when you sell it, you have to determine gains and losses. Again, people will call us and they'll say, I shut my S corp down. What do I do? I'm there, well, you got a capital gain or loss. What happened? And they said, well, I don't know what the client did with everything. Well, IRS has been getting these K-1s, they've been getting these returns for years on you, and now you've disposed of it. You've disposed of an asset. You've got to account for it, and you may have a loss. You may have a gain. You have to be able to keep basis records. So what is basis? Well, it's the original cost, and it gets increased based on what happens. These are the things that will generally increase it, is when you put more money in it. So if you start off with $10,000 as the original investment in it, and you put more money into it, then your basis will go up. It'll also go up if you recognize income or gains on your tax return. You get that K-1 that says it made $10,000. You say, okay, $10,000. My basis just went up by $10,000 because I'm recognizing I'm going to pay taxes on that money. Any other gains in anything? This is one also people need to remember, tax-exempt income. If you have tax-exempt income, you don't pay taxes on it, but your basis in your investment goes up because the entity received tax-exempt income, so it made it more valuable. If it got a income, so it's going to go up. It goes down when you have losses. It goes down when you take things out of it, when you take assets, when you take those distributions. Remember earlier, and I said, client will call up and they'll say, I took $20,000 out. What do I do with it? It reduced your basis. That's all it did. It reduced your basis in the investment. And then the last thing, basis will be decreased when you have non-deductible expenses. You can't deduct them, but guess what? You still have to pay non-deductible expenses. Last time I knew, when you purchased a meal, maybe you can deduct 50% of it, but usually you paid 100% of the check. So that's how that would work. All right, so that's kind of just it. This is kind of a representation of what basis does. Debt basis is computed basically in the same way, except that it includes anything in which the entity, the shareholder or the partner is going to be liable for. Why is this thing? Remember I showed you these, how they're different? And this is in the partnership. The partnership keeps track of all of that information. What was withdrawn, what the basis, what your basis is. So when you get this thing and you're looking at this, there's all this information over here that's telling you what your basis is in the entity. There's your S corp. Look what they gave you. Nothing. So the S corp's not telling you what your basis is. It's the taxpayer's responsibility to keep track of that. And unless I'm mistaken, a lot of taxpayers think you're taking care of all of that for them. You're keeping track of their basis. So that's a big difference between partnerships and S corps. And then the final part, that's just showing it again. All right, so solely responsible. There's a Treasury reg that says that shareholders are solely responsible for keeping track of their basis. And they have to maintain those 2 items. If you don't have that information, they're going to be limited in what they can do. All right. And now the third part is the distributive stuff. Most entities, all 3 of them, they have various items that can be distributed. The only thing that's treated the same are those 3 things: interest and dividends, coming from the different entities. If they're coming, if it's something else, it's not going to be treated the same depending upon the entity. So let's talk about how we enter them. Okay, all of this is entered in on the income menu. You've seen that. You go into the income menu, you click on K1. It asks you to create one or to pull one. Very common. If you pull one, you have to answer. Let's say we go in here, you have the option to pull them. And you said you want to pull it over from the business package. You did the K1, you did the entity. It's going to ask you a series of questions. It's going to ask you the first question. It says, is it a passive activity? If you answer, it is, it's going to, if you have the choice here to answer whether it's passive or non-passive. So if you answer it is yes, it's going to do things. So this is what you have to do. What is passive versus non-passive? Again, an area we get lots of questions on. There's 2 types of activities. One's passive activities. It's where you don't materially participate in something. And we'll talk about that briefly here in a minute. Or when you're a real estate professional. When you're involved in real estate. All real estate is passive. Unless you are a real estate professional. Real estate activities are always passive by definition. So, to materially participate, people call us all the time and they say, how do I answer that question? And I ask, does he materially participate in the entity? And they will answer, oh. And I usually say to them this. Was his participation or her participation, do they work in the business? Yes. Are they there every day? Yes. They're substantially participating in the activity. That's really what it is. If this is their business, if they're working in it and it's not real estate, yeah, they're materially participating. You don't need to keep track of the 500 hours and whether or not it's more than everybody else. If this is their business, of course they materially participate. Nobody else is doing it. That's what they do. So if they have a business and they're materially participating, and they can try to meet all of those technical tests. We're not going to worry about all of that. And so the other question is for rental activities. This one comes up a lot too. Is to be non-passive in rental activities, you have to be a real estate professional. People will call up and they'll say, I have a real estate professional. I'm saying, okay, great. Why is that? My client has a real estate license. And they're great. Why are they a real estate professional? Having a real estate license doesn't really mean anything. It just means that, yeah, it's indicative you work in that world. But I had one client who called up and he said, my client is a real estate professional. I said, well, I see on his tax return he has $700,000 in income coming in from this other source. What is that? And he says, he's a surgeon. I said, okay, he has a real estate license, but he's a surgeon. I don't think he's performing more than half of his services. He's a surgeon. He's obviously doing that. He's not spending more than half of his time in real estate. He's doing that. So you can't, just because they have a real estate license doesn't make them a real estate professional. They have to work in it. They have to spend at least 750 hours in it, and that has to be, they have to put more hours in that than they put in any other personal service business that they do. So if they're an attorney, they're a doctor, they're whatever, they have to spend more time here. They, or it could be their spouse that does it. So if they have to answer these questions, is it a passive activity? Answering yes makes it passive. Once it becomes passive, everything gets limited based on the 8582. It's going to be considered a passive activity. If you say no, then you get a second question. The second question is, you know, did you materially participate? You say it's not passive, you materially participate. You have to affirmatively say, yeah, I materially participated. So if you want it to be non-passive, you would say it's not a passive activity, and you would say that you materially participate. The same way when you create a new one. When you create a new one, we go through this process. We're going to pick the, come on now, quit that. And we get here, we're going to get an entry screen. You're going to fill all this out. We're going to get down here. If it's publicly traded, we'd mark that. But you get this here, and you'll see you'll have these questions. You have to answer these questions. Is your investment at risk? Then when you get here, you're going to be asked to put in the entry. You say it has income. Then once you we click on the ordinary income, we'll get another box, and it's going to ask us if it's non-passive or passive. If it's non-passive, you know, they materially participate. This is what they've done. It's a non-passive income or loss. Putting it in those boxes makes it flow to the tax return as just ordinary income, and it would also be non-passive income. If you put it in as passive, then it's going to go. The next one is if you click on real estate, it's going to ask you these questions. Whether or not it's, if materially participating, that means you're a real estate professional, you would put your entry in there. If you're not a real estate professional, you're just an investor, you would put it in as non-active income. But if you're not a real estate professional, but you participate, you're the only person that manages this rental property or whatever, then you would mark it as just being active income because it's a different standard. Let's talk about our issues here. These are the ones that we most commonly see, because we're going to run time. One of the most common things that we will see is people misclassify this. We get a lot of folks that misclassify that passive versus non-passive item. What we were just talking about, people will classify income as being passive. They'll click on that box or they won't know, and they select the wrong one. And if they select the wrong one, they get the wrong result. So when you have an income, when you have something coming in from a taxpayer, when you're looking at that K1, you have to put it in the correct box. You have to know if it's passive versus non-passive. If you designate it as being passive, as your income is being passive, every item on that K1 will be treated as a passive activity. If you treat it as non-passive, every item will be treated as non-passive. So that's a very common problem. Why is this relevant? Rental losses. There's this allowance. You probably have dealt with this on Schedule E's just without dealing with K1s. But there is a special allowance. You can take up to $25,000 of losses if your income is under certain things. But this is when you have to have active loss. You have to have an active. So people will make this incorrectly. They'll either mark it down, they'll put it down as non-passive, or they'll put it down as, as passive. So if you enter in your loss, you have a loss on your K1 on that rental field, and you enter it in as and incorrectly, not as active, you won't get your losses. Yes, sir?
So somebody that doesn't want to take care of the property, even if it's rentals, would be an active income.
Yeah, if he's renting, if he's involved in it, there's two things. Like, let's say, I buy an interest in a rental, in rental property. Somebody else is managing it. I don't do anything. I just give you money. I just purchased an interest. That is a passive investment I made. However, if I buy a rental property and I'm the one that looks at leases, I'm the one that picks tenants, but it's not my business. I have a full-time job. I do something else. I'm not a real estate professional, but I am active. I am an active owner. I am active. There's nobody else doing what I do. If the sink, if there's a water leak, I'm the one that calls the plumber. That type of thing. Yeah, you're an active investor, and so you would be allowed to take these losses if there are real estate losses. But again, it's one of those things that just people kind of get confused on. Disallowed losses. Losses get disallowed. if they're passive. And that's another one. And it's your responsibility, the taxpayer's responsibility, to track their passive losses. We get a lot of questions on passive losses. How do I get to take passive losses? The way you take passive losses, they get applied against future passive income. You can only be taken against future passive income unless you dispose of it. You probably have dealt with this on rental property. You dispose of a piece of rental property, it's had losses for years, you dispose of it, and all those losses come forward. You get to take them the year you dispose of them. Same way with a K-1 entity. You have losses for years and years and years that you couldn't take because they were passive losses. You dispose of it, you can take them all. Because they're known as reclassified losses. The way you would do that is you would go in here and you see here, if you've got passive losses, you would put them in on these lines. You would carry these in. You would put them in. If you disposed of it, you would mark up here that you disposed of the entity. And then you would just simply put them in as reclassified losses. Suspended losses. We don't get this question as much as we should. I see it all the time on tax returns, and I ask preparers about it when I'm talking to them, but they don't recognize it. Well, I said earlier, you have to keep track of your basis if you have an S-corp. If you don't have any basis, you can't take your losses. Those are known as suspended losses. You can take them in future years, but you can't take a loss if you don't have any basis. But people take them. And we get a lot of letters from, the IRS sends a lot of letters because guess what? They're sending over that information on those K-1s year after year. And an entity's having losses year after year. And they're there like, where's your basis? Show us your basis. And the taxpayer doesn't have any record of this basis that they can do, and they can't take these losses. Those would be known as suspended losses, but they don't take them. NOLs. Again, NOLs are not carried on the tax return of the individual. People will call and say, my entity's had a loss last year. What do I do with it? And they're, well, you should have recognized that loss on your individual tax return last year, and you don't carry it over. They don't carry over from year to year. When they get disposed of, I mentioned earlier, this is real common that we get people will call us with disposed entities. And a disposed entity, and they'll say, what do I do? And this is what I have to tell them. If it's a gain or loss, it goes on here. If it's an asset sale, it's going to go on here when a partnership. Otherwise, it's just going to be a Schedule D transaction. And then we treat these things, which again, suspended losses. If you have a suspended loss and you don't have any basis and you sell the entity, it's lost. S-corps, very similar, except that you don't have the ability to go to the 4797 because it's not. Again, your suspended losses will be lost forever. We'll move on because we're going to run out of time here. And publicly traded. Losses from publicly, any of you deal with publicly traded partnerships? You see some? One of the unique things about a publicly traded partnership is that they're very commonly run with losses. That's very common. They're most common in the oil and gas industry. You do see them in a few other areas, but it's almost always oil and gas. That's the most common ones that I've seen. And lots of times they run losses. And those losses can only be offset against gains from the same publicly traded partnership. And the program will actually track it. There is a separate worksheet. So if you have a loss on a publicly traded partnership, you'll not be able to take that loss on your tax return until you have a gain. But again, when you sell it, it all comes home. You get to recoup your losses at that point in time. And publicly traded partnerships, they're here on the entry menu, and it's going to be right there at the bottom that you would put in this thing here, and you would mark, if this is a K1, you would mark it yes, and then it would be down here, you would put in your prior year publicly traded partnership prior year losses, and that will track them. They also are on the worksheet, and they'll pull forward if you did them last year, if you've been doing the tax return. Guaranteed payments. Have you ever encountered guaranteed payments? Guaranteed payments are a partnership item. When you get a partnership, people will call with that question. I've got something on my K1 from a partnership. It's in box 4. It's called guaranteed payments. What is that? Well, when you have a partnership, if you and I are in partnership and you're working in that partnership all the time, and I'm only marginally involved in it, so we agree that you're going to take $2,000 a month out of that partnership every month. And we're going to guarantee you're going to take $2,000 out. Those are known as guaranteed payments. You'll take that $2,000 out a month, and at the end of the year, that $2,000 a month that you got will be subtracted from the ordinary income of the partnership. When we divide up the ordinary income, you and I are 50-50 partners, we'll each take 50% of the ordinary income, but we've already deducted those guaranteed payments that you received. Well, you'll get those. That's just ordinary income to you. You have to add that back in. Yes, ma'am.
I have a question about that. The guaranteed payments that go to one partner, does that affect her basis in the partnership?
Will that affect her basis in the partnership? Well, the only way it's going to affect her basis in the partnership is that yes and no. It's not going to decrease her basis but it will affect it because it's decreasing ordinary income. So she'll only get half of the ordinary. The income will be deducted. Yeah. That's because see that got expensed, and that's not that got expensed by the partnership.
It's not like her taking.
No. She got the cash. She would get the cash. She's going to have to pay self-employment income on that. All of that's going to all occur, but it's not going to affect her basis. She will have the benefit of it not reducing her basis. And anyways, now sometimes guaranteed payments are not treated that way. And that can occur when you have a guaranteed payment. Let's say we have a partnership and I'm the investor, and I was guaranteed $2,000 a month for putting up the money. I don't do anything. I put up the money. I'm a passive investor in that case. That's all I was. And that type of guaranteed payment will still be reducing income, but it won't be considered self-employment income for me because it's investment income. It's going to be treated a little differently in that scenario. All right, unreimbursed partnership expenses. Why in the world anybody has unreimbursed partnership expenses, I have no idea. But this question comes up. Unreimbursed partnership expenses can reduce your self-employment expense. I personally, if I was in a partnership, I would rather have reimbursed expenses than unreimbursed expenses. These are just expenses that I incurred as a partner that the partnership didn't pay me for. I'd rather get paid for them, let the partnership take it as an expense. But if you have some of these, people do this, and it will reduce your benefits. And the way you have to do that is on the K1 entry screen, you just go into your self-employment and reduce your income right here as unreimbursed expenses. But that question comes up commonly. People have it. All right, we're going to have to wrap up here, but we do have a lot of resources. We made a major focus over the past 12 months to enhance the knowledge base. We put 32 articles on K1s in the knowledge base. As I said, we just really skimmed the surface here on everything that can be happening in a K1. But we created all of these knowledge bases. And when I have an asterisk by that, they're all published, but there are additional ones that we haven't published yet that will track with that. They may get published before tax season starts. I can't promise that because there's just so much other stuff that we're dealing with. But we have all of these different K1 articles, knowledge base articles that explain all of these things, including a line-by-line article on how to enter various items from the various different sections of the K1. And I'm going to scroll through them here because I want to get to, they're on each section of the K1, each item. And the way you would get in here is you go into the knowledge base. If you would click on here, in this case in tax questions, it's going to create a section now. There's a special section that simply says K1s. When you click on K1s, it will tell you the different type. You can click on that, and we'll go into the 1065 one. It's going to give you a list of articles. You can see any of these articles. I know, we're wrapping up. Any of these articles, and you would then click there, and you're going to get a detailed article that's going to tell you line by line what everything is, including every line on that K1, where to put it. So that can be very helpful when you get something that's, like I said, really in the weeds. And it could be, you know, something in line 13, code J. There's going to be a section in this article, line 13, code J. Just going to tell you, and it'll be a couple paragraphs. It's going to explain it exactly where you need to go. So, any questions? I'm sorry, we went through a lot of stuff very quick. I took a conference many years ago, about 5 years ago, or it was more than that, and I was there for 3 days. It was a 24 hours. I got 24 credits for it, and it was just on this subject. And at the beginning, the person that was doing it, he says, I have to apologize to all of you because we don't have much time to cover the subject. So there's that much depth. So if you all have questions, please come and ask me.